All right, guys. How's it going? Good afternoon, good afternoon to everybody. Option Sniper here, and we're going to start soon. So I'm glad that the live stream is now working well today. No issues like last time. So let's just wait a couple more minutes, and then I will start. Everybody can hear me well, right? Just type something in the chat. If you guys can hear me, just type something. Making sure there's no... Okay, he says you can hear the clicking, so assuming you guys should be able to hear me as well. All right, good. Okay, so this says we only have 10 people, but there's like 20 people in this chat, so I'll wait. Let's see if we can get 15 here in the next couple minutes. All right, so we have 15 now. I'm going to go ahead and dive in here. So we're going to do a little bit of review, and then I have some new stuff to share with you guys as well. There's some things we want to go back over again, and then we're going to focus on making this interactive. And moving forward, I want to make sure every Sunday that you guys come ready with questions that you want to ask. Because I think the advantage of going live is being able to make it, like an interactive type of group session where we can address everybody's concerns and questions. And that's how we can best help you guys, is by knowing exactly what it is that you want to learn. So let's do that moving forward. And I hope everyone has some questions, because we set aside 30 minutes today to just interaction for whatever it is you guys want to go over. So I'm excited for that. I think that's the biggest advantage of going live, is spending time together and kind of, going over whatever it is that you guys feel like you would like to learn about or need help with. So, okay, but for the first 30 minutes, we're going to go over some technical stuff. And then I also have some stuff that I pulled from Bloomberg that I'd like to share with you guys as well. So let's just go in here. We're going to start off by looking at We're going to start off by looking at Bollinger Bands. I know we did cover this briefly, and also the 5-period RSI. So yeah, some of this stuff, if you were here last week, some of it's going to be a little bit of review, and then there's newer stuff towards the end. And then if you have any questions, I'll just look back and see. So, okay, and I'm also going to talk about what happened in the market on Friday and last week. So as we can see, if everyone's familiar with the Bollinger Bands, or if you're not, on this chart, it's these two green bands, and then it's the green dotted line. So the green dotted line is the 20-day simple moving average, and it's always in the middle of the Bollinger Bands. And the idea of the Bollinger Bands is that the market a lot of the time is mean reverting. So whenever you get up towards the bands in either direction, usually the market will come back towards the middle. And basically the two bands, so the setting on this Bollinger Band right now is 20 simple moving average and then 2.0. The 2.0 means the bands are 2 standard deviations away from the 20-day SMA in the middle in both directions. So whenever the market gets 2 standard deviations away in either direction, that signals that it's overextended and ready for, at some point, some type of a pullback in the other direction. So as we can see, the market, we've been really strong since Trump got elected. We've just been rallying, and then since we broke that 2280 range that we were looking at for weeks there, we've been really strong, and then we got through 2300, and now we've already gotten to 2350 in a very short span of time. Looks like we can head towards 2400. Now next week, I think that the market is just so overextended. So the RSI is the relative strength indicator or index. I like to use a 5-period for shorter term. And what this means is that when it gets above 70, that shows that the market is overheated and due for some type of a correction or a pullback. And then also if it gets below 30, it means the market is oversold and due for some type of a bounce. So we can see we're a very high reading on the relative strength index of a 5-period, which is a great thing that I like to use for shorter term. Just give more beginners a better idea of when we should be buying into trends. And I also just want to cover a little bit about price action and trend analysis and trend entries. At this point in time, when the market is this overextended, we should never be looking to get long here. What we should be doing is we should be waiting for a nice retracement / pullback for an entry. Whenever we know. So this trend can be categorized in a couple different ways. Now, I want to cover moving averages as well. I have the two most important medium-term and long-term moving averages on this chart. The 200-day is a very important long-term moving average. When price is above the 200-day, that's bullish and signals that the market is in a bullish uptrend. And when the price is above the 50-day, that's medium-term bullish and signals the same thing. Now, you can use both of these lines, the blue and the red. When the 50-day is above the 200-day, that is also bullish. And what people look for is when these lines initially cross. So when the 50-day crosses above the 200-day, initially that's called a bullish cross. And when the 50-day crosses below the 200-day, that's called a bearish cross. Now, what I did is I went back all the way to 1987, and I pulled all of the most bearish retracements that the markets had. And we'll see on there on my Bloomberg charts that the first thing that happened is, before the trend even started changing, is that the 50-day and the 200-day obviously came closer together, and then eventually the 50-day crossed below the 200-day, which is kind of the first signal that trend is starting to change. So right now the market looks fine. It looks very strong. When the 50-day is separating itself from the 200-day, so when the distance between the 50-day simple moving average and the 200-day simple moving average expands, that means that signals the strength of the trend. When the distance is expanding, the trend is strengthening, and also usually price is gaining more distance from the 50-day. So yeah, that's basically everything going on in this chart. Now, what we can see with these indicators that we have is that the market short term is very overextended. And like I was saying before, we know that we're in an uptrend categorized by the 50 and 200 day and price. Now, what we want to do in an uptrend is we want to enter at a good retracement point, because in trend, especially in uptrends, in downtrends as well, you always get pullbacks, right? You always get the market stair steps up. So the best time to enter a bullish trend, a long-term trend, is on a pullback, right? So the best time to enter a bull trend is on a pullback in the market. And so we haven't really had that here the past couple of weeks, but what we do want to see, what we'd like to see, where we could start getting a little bit more aggressive in some bullish trades, is we would like to see the market kind of taper off a little bit. We'd like to see the RSI come back below 70. We'd like to see price come back towards 2320 at the very least, and then we can start kind of structuring some more trades. But it's just right now is not the best time to be entering a lot of bullish trades, just because there's so much risk to the downside because the market is so overextended. So, I mean, that's the thing that everyone needs to keep in mind, is when we need to know the overall trend. So the overall trend of the market is up. We're in a bullish trend. Now, we know that, and so we should be looking to get into this trend on pullbacks. We should not be buying into the teeth of the rally. We should be buying into sell-offs. Which is why, last week with Expiration Friday, I have some theories with that, but I really thought that the market would kind of dip on Thursday and possibly into Friday, but I feel like a lot of the time on Expiration Fridays, the market likes to rally, and it's just basically some stuff that I've been watching, but I mean, with that, it just signals that the market's even more overextended, and I think that because that happened, I think this week there's a better chance that we're going to get some type of retracement, and it didn't happen last week because of Expiration Friday. So yeah, and I mean, the other thing that we always need to emphasize, most of the time we're swing trading, we're holding our trades for, anywhere from a couple days to a couple weeks. So when we're swing trading and we're looking at daily candlesticks, the most important thing to always be aware of is the previous day's high and low, and whether or not we close above or below that. So, I mean, yeah, so that's like basically this chart summed up all the things that we should be aware of and we should be looking at. So yeah, and I want to go to one other thing where when I'm talking to you guys about entering the primary trend on a pullback, right? So we want to enter this bullish trend when the market pulls back. One of the best things we can look at here, the Bollinger Bands are great because if we pull back towards the 20-day moving average, that's a retracement as well. But the thing that I like to look at the most is the Fibonacci retracement levels. I did pull those. Now, it's going to be hard to see the chart because it's so zoomed in, but I'll just tell you guys here that the actual retracement is measured off the short-term rally. So it's from the low that we made on January 31st right here, to the high that we made up on Thursday. So I measured the Fibonacci's on there, and a good entry into this new uptrend would be a retracement back down into the Fibonacci retracement zone, where we could get a little bit more happy about entering a trend because it's kind of retracing a little bit. So we'll go down and just go right here. Okay, so as you guys can see, this is a zoomed in chart, so it's harder to see, but these are just really zoomed in candles from Thinkorswim. And I use the Fibonacci retracement tool on there, and the way to use it is you go in this drawings toolbar and you can pull up the Fibonacci retracements. You can edit it however you like. I edited mine so that the 382, the 50, and the 618 are the only ones that show up. Those are the most important levels. So as we can see, as I was saying, 2320 would be a decent entry point into this longer term trend. Well, this shows the same. The 2819 level is a 38.2% retracement of the actual move that we've had from January 31st till Thursday, right? From 2267 to 2351. That's what this retracement is measuring off of. A 382% retracement would be down to 2320. Now, the best place to enter a retracement is at the 50% retracement level, which would be 2309. And then, like I was saying before, the 2300 level is a really important level, and what's kind of cool about these levels is that it lines right up with that, right? So the 618 is at 2300. So what the 618 means on the Fibonacci's is when price retraces below to the 618, now the trend has less of a probability of continuation to the upside. And if price closes below the 618 retracement level on the daily, that means the trend there's a much higher probability now that this trend is going to reverse to the downside. So 2300 is the key level that we're watching here in the market, as measured because at first it was just support and then we busted above it, as shown on this chart here. 2300. I mean, it was resistance and then we busted above it. So it is the strongest level of support that we have here short term, but also. We also have here the Fibonacci showing the same exact thing, as 2300 is kind of the line in the sand of when we no longer should be bullish. So basically, when we're trying to enter this long-term bullish trend, we want to see the market retrace back down towards this 382 and 50% retracement levels, and that's going to give us a great entry into this bullish trend. I never want to enter a lot of my trades into the teeth of the rally, because if we enter a lot of trades up here, we're just so at risk for a pullback in the market, just because we're so overextended. Everything. I mean, the RSI. You see this 5-period RSI is a good way to see, and then also the 2 standard deviations on the Bollinger Bands. So, okay, so I think that's most of the technical analysis. Now, the other thing that we wanted to go over here for a little bit. Actually, I'll stop before I go there and see if there's any questions. Okay, so people are saying there's like connection issues. That's unfortunate. Yeah, I mean, this is recording, so when this stream is done, it's going to be uploaded as a recording. So, and we're already like 15 minutes in. Okay, it keeps buffering. Okay, yeah, I mean, I don't know what, I guess I don't know what should we do? Should I just stop this and then, I don't know, you guys let me know. Is it even worth? Okay, it was okay until I got to that last slide. Okay, I mean, can you guys make out what I'm saying? Should we just stop? Just let me know, guys, because if it's too much and there's problems, there's really we'll have to pause it and try coming back or whatever else. Okay, yeah, I'll try and refresh. Well, I mean, to refresh, I have to stop the stream and then start it again, right? Okay. All right, yeah, I'll just continue, and then it's going to be recorded and uploaded. So we'll just power through this hour. I guess it's not going to be as interactive as I had hoped, if you guys can't really make out what's going on. I hope that it gets better. But okay, so yeah, I'll have to try and, after this uploads, I'll have to try and figure out what's going on. Nah, my computer is not on Wi-Fi. It's plugged in. Um, but all right, I'm just gonna keep going. Okay, so the next thing we're going to cover is divergences with the MACD. This is kind of review, but it might be newer for some people. So I just want to give an example of the best way that I like to use the MACD. Now, there's two different ways that people can use the MACD. They use it for crosses, right? So bullish and bearish crosses. Here's an example right here of a bullish cross. You see the black line crossed above the red line, and the blue bars went from negative to positive. So that's an example of a bullish cross. As price was spiking up here, the MACD gave a bullish cross signal, and then the trend started up. And then here's an example of a bearish cross right here and right here. This one's a tough one because it's kind of a fake signal where you got a bearish cross, but the market didn't really move much. So that's the thing with the MACD. If you play it just off the crosses, you'll get some false signals. But here's a good example of a bearish cross where we had the cross, the bars crossed to the negative side, and then price started going down. So that's the first way that a lot of people use the MACD is for the crosses. Now, I think the best way for using the MACD is to find divergences. So here's an example of a bullish divergence where price went to a lower low, but the MACD actually went to a lower high. And you can see there that that's a powerful signal that the trend is likely to reverse at some point in the near term. It doesn't mean it's going to reverse tomorrow or guarantee anything, but it is something to be aware of, that the trend is likely to reverse within the next, couple of days to couple of weeks. It's just something to track and make sure and be cognizant of. And what happened here was this divergence set up, and then price started taking off. Now, when I see a divergence like this, the first thing that I will do is I will look to see if a candle closes above the previous day's high, which is here. So this would, to me, would be a first signal, as this is kind of like a bullish hammer pattern on this candle. And then the next day we get a close above the previous day's high. This is actually a decent entry point where we could put a stop below this day's low. And then if the trend does reverse, we can start to ride it up, which is exactly what happened. So we got the divergence, and then we got the bullish cross. And here was our kind of price signal. So I always like to use price. All these indicators always lag, especially the MACD, and anything that's derived from price is lagging off price. So that's why I say, the best way to be trading the market is just by using price and volume and some moving averages and Fibonacci levels, anything that's just price oriented. Now, indicators are good because they give you, they're kind of like training wheels where they give you a look. They help people see things, but everybody should be able to get to a point where they don't really need indicators besides like just to see divergences. I think that's the best. I think the MACD is the best tool just because it's a great way to find divergences, which means if you can catch a reverse in a trend in the beginning, that's obviously how you profit the most. And what we saw here was that divergence, like I said, and then a close above the previous day's high, which would have been, to me, using price, a decent point to enter into a bullish trade. So that's an example of the MACD and divergences. And let's see what else here we can cover. Let's see how everyone's doing. Okay, so there's nothing typed in there yet, or there's nothing typed, so I'll just keep going. And then hope when this uploads that it uploads okay. Yeah, I don't know if it's going to or not, so it's kind of frustrating. I'll have to take a look at what's going on after this, but okay, so a couple other things I wanted to talk about and show you guys. just briefly, so we talked a little bit on Friday about spreads and tighter and wider spreads, and I just wanted to give an example of how, kind of each work and the benefits of both. If everybody's familiar with debit spreads, right? So I think because we have covered spreads a lot, so I'll just give an example of kind of how they both work and the benefits and kind of, advantages, disadvantages of both. So what Dave likes to do and what he's had a lot of success with is he likes to use tighter spreads, which that's great because tighter spreads give you less risk. So basically on Friday, I think some people had a 119, 120 Celgene call spread. Celgene ended up closing at 121. And so the advantage of a tighter spread is that you need the stock to move less to max your gain. And I mean, the disadvantage is that you can miss out on upside if it overshoots. So I mean, that's basically the idea behind it. Now, when I look at spreads, I kind of look at them differently, and that's why these are called options, right? There's so many different ways that you can look at the market, and there's so many different options that you have. Now, this was a little bit different because this was just a Friday expiration spread. But even more, when I look at longer term spreads, the thing that I always think of is I'm always looking for the top strike, like I'm talking debit spreads. I'm always looking for the top strike to lose. I want it to lose most of its value. Like I use the top, when I do a debit spread most of the time, longer term and even sometimes shorter term, I use the top strike that we're shorting, right? We're selling to open the top strike. I use that just to benefit my long leg, right? So I use it to lower the cost of my long leg, and I'm actually in the hopes of that top strike expires worthless or becomes almost worthless. And I don't necessarily want to see the stock get anywhere close to my top strike. I just want to use the top strike to lower the cost of my overall trade. And I'm happy to go further out and shorter a higher leg just to lower the cost of my trade. And it doesn't necessarily mean that I want the stock to go to my strike with the top strike, if you guys get what I'm saying. Now, I think the way that, and that's one way to look at trades, and the way that Dave likes to structure his trades is he usually wants the stock to get to the top strike and just capture the game between the two tight strike spreads. Now, it's way less risky to do it that way, which is great, and it's just less reward. So it's just risk reward, right? If you have a wider spread, obviously you're risking more, but your reward's better. And then, when I look at spreads, like I said, the first thing I'm looking at is I just want to lower the cost of my long leg, right? Because you know how we're buying to open, that's the long leg. I just want to lower the cost of my long leg, and I don't care if the top leg expires worthless, whatever, or the price doesn't even get there at all. It's just a benefit to me, I think. And the other question is when to just buy to open calls and when to do spreads, right? On the call side, I think we should almost always be doing spreads, unless you're day trading. The only time I think that we shouldn't be doing spreads on calls is if you're day trading. If you're not day trading and your holding period is longer than a day, I think my opinion is that we should always be doing spreads on the call side because we want to always be hedged. We're hedged a little bit because we're shorting the top strike call, but we're also helping ourselves benefit if the stock doesn't move right away and the stock doesn't move hard enough. And we're lowering the cost of our trade, and it lowers our risk a little bit as well, because if the stock moves sideways or moves down, that top strike is losing value, which is benefiting us at least a little bit. So my opinion on when to do spreads and when to just do a buy to open a regular call is that I think we should always be doing debit spreads if we're holding for longer than a day, just because that top strike that we're selling to open is kind of mitigating some of our risk while also can still benefit the trade if the trade doesn't move right away. Because when that top strike, we're short that top strike, so when it loses value, it's helping us. So I mean, that's my opinion on spreads and when and when not on the call side. Now on the put side, my opinion's different. Just because when the market sells off, it sells off very fast, and there's a lot more money to be made in a fast manner. So usually on the put side, I'm more apt on the put side just to buy to open some puts and not spread it. But if I'm going long term, if I'm going further out, the further out I go, the more likely I am to spread it on both sides just to lower the cost of the trade and for a time decay to benefit the trade. So yeah, I mean that's kind of that. Let's see if are we doing okay here. Panda, deltas are always something to take into consideration. And that's another thing with spreads is that the wider your spread, the larger your delta is going to be, right? Because the leg that you're short is, so take for example though, if we did the 119 120 call spread, right? And it depends too on when, like how long you're going out. So if you're just, say we're buying a trade on Thursday that expires on Friday, the delta isn't as important, but it does still matter, right? I mean, the delta always matters. So just another example of spreads. If you look at, say if we do the 119 120, our net delta is only 11 cents. So every dollar the stock moves up, we're going to make 11 cents, right? And then that continues to change as it goes further. But the gains are going to be capped out once it goes above 120. So I think we should look at, okay, let's look, since this is at 121 now, let's do an example on the 121, 122s. So basically, and it also depends on if you're going to hold to expiration or if you're going to sell before expiration. There's so many variables. So when I'll give an example of both. When I go out longer term, deltas matter more because when I go out longer term, I'm not going to be holding that spread until expiration. So when I go out longer term, delta matters more to me, which is why I'm more apt to go wider on a spread, right? So say I was going to do Celgene, I was going to make a bullish call spread on Celgene that's going to go out a couple weeks. I would much rather go with the 120 I would much rather go with the 121, 123 because we have a 25 net delta. You see what I'm saying? Because we're shorting this, so that's 28 that we're losing, but then we're 53. So our net delta is 25. Whereas if we do the 121, 122, our net delta is only 13. And also we're capped. As soon as it goes to 122, we're capped. And then here, if it goes to 123, we're capped. So it's just, I still look at the deltas, but I don't look at, when I'm doing spreads, I don't necessarily like calculate my delta. I just know that the wider the spread, the more upside that I have. And obviously, the more upside that we have, the larger our actually net delta is. And then depending on whether or not you're going to hold it like to expiration, also matters as well. So like, I guess if you give like a more specific, like what exactly are you asking for deltas with spreads? Like, are you asking for trades like where we open them on Thursday for expiration Friday, where a lot of people just hold till till the thing expires, because then the delta doesn't matter as much. But if it's longer term, it does matter more, which is why I'm more apt to go out with a wider spread, and there's more upside and more risk as well. But I think on the call side, it's always good to short, right? Sell to open a strike instead of just buying a call, because we're hedging our risk a little bit by shorting a call, and we're also, the market is more prone to just go sideways, and so we're not fully just exposing ourselves by just buying calls. So I mean, that's my opinion on the call side. So for a weekly spread, open on Monday, close Friday. How's this coming in? Is it still choppy? Okay, I'm hoping that it's getting better. So Ragu, you asked why only talking about calls. Well, okay, good. I'm talking about. Good. That's good to know. All right. Very, very happy with that. Good. So this session can go back to being good now. All right. Okay. So actually, Ragu asked a pretty good question. Like, why was I only looking at calls? Well, I was only looking at calls because we're in like a big bull market, and we should be looking to enter when we actually do get a retracement. We should be looking to enter the primary trend, which is up on a retracement. Are puts good with spreads? Yeah, I mentioned briefly, like it depends on the holding period for me. And everyone has their own preference. Whereas puts, I'm more likely just to buy to open puts, even if I'm gonna hold them for like a couple weeks, just because when the market sells off, you're really capping. The thing with spreads is you always cap your upside. Obviously, because you're selling to open that top strike. Where with puts, you can really make a lot of money if the market sells off fast. So I don't really like to cap my upside as much on puts. It depends on how long. If I'm going out like 4 or 5 months, then yeah, I'll always spread it in both directions. But if I'm going out on puts like anywhere from a couple days to a couple weeks, I usually just buy to open a put instead of opening a spread, just because I want to capture that that additional upside. And usually when I enter a put, I'm pretty confident that the market's going to head down the next couple days. I don't just buy puts to hedge. When I buy puts to ride the market down when we finally get weak. And then, so if I was buying a spread at that point, I would really be hurting myself. So that's kind of why I'm not as big as on spreads on the put side. Whereas on the call side, I think we should almost always be spreading it. So, yeah, okay, that's a good question. So say we did a weekly spread, we open Monday and close Friday. Yeah, you could do both, Anthony, for sure. If you're gonna do both, though, I would caution to say, don't do it all on the same stock. Maybe you buy a spread on a stock, and then you buy just some calls on like an index ETF like IWM or SPY or DIA. Just don't put all your eggs in one basket if you're going to do that. But yeah, I mean, you could do that as well. There's so many different ways, and then also you're obviously risking more if you have spreads and calls open. So, I mean, the risk management part, right? There's money management part, not risking too much. But yeah, I mean, that's definitely something to consider. Now, for me, I think that, like I said, I like to usually spread it. But I mean, if we're in a huge bull market and we're really strong, there's no problem with a little bit of both, and there's no problem with even just buying calls. But if you're just buying calls, you're really susceptible, especially right here where the market is. If you're just buying calls, you're really taking a risk, in my opinion, because we do see how overextended we are. But yeah, I mean, you could definitely do that, Anthony. So that's a good point. Okay, so let's hear. I think Panda had a good question to look at, like a spread and the examples of a wider and more narrow. So let's look at that just to see the benefits and drawbacks of both. Now, the other question I have for you, Panda, is what is your plan? Let's really start interacting here. So you say let's open a weekly spread on Monday to close on Friday. Are you going to? Do you plan to hold that till expiration on Friday, or what if the stock? I mean, what if the stock moves above your strike on Wednesday? Are you still going to hold it till Friday and leave that risk on the table? So those are questions we need to be thinking about, not just like, yeah, we open a spread, but it really depends on what our plan is. I know Dave. I think Dave usually likes to hold until expiration, but I usually like if I buy a spread and I get a move a couple days in advance, I usually don't hold. I'll just take the profits, just because I don't want to deal with that extra risk and being greedy of I just want to see it expire above the strike. But But if that's your plan, that's your plan. It's not necessarily being completely greedy, but I just think if you can take most of the profits a couple of days in advance, I don't see the reward to risk on that is not, in my opinion, worth it to hold it in a couple extra days to get like a little bit extra when you're risking all that on the downside. It's just not worth it, in my opinion. How can we decide to go with calls or a call debit spread? Any way to hedge calls with the spread or in the opposite way? Yeah, I mean, Anthony, we can always hedge our calls by buying puts. So, and then how can we decide to go with calls or a call debit spread? Okay, so let's look at an example. Let's say we're going to open a Celgene call spread for next week. And let's look at this option chain. And I'll just give you a broad range of strategies and plans, because it's really hard. You have to, before you enter a trade, guys, you need to know your plan. You can't just so you got to be really specific, right? You can't just say I want to buy a call spread on Monday and then see what it does by Friday. That's like a recipe for failure. Okay, yeah. So, and also if it's just a one strike, if it's a 1 point, if it's a one strike wide, then it's also less risky. So, but yeah, I mean that's kind of my idea about it. Now, everyone, like I said, there's so many different ways to perceive and see the market, and nothing's more right or wrong than anyone else. It's just people do things. Some people see things differently. Some people do things differently. And both ways can be fine, and both ways can be helpful in other assets and other aspects. It's just beneficial for everyone to be able to see, the market through everyone else's lenses, and kind of see all the different perspectives. I think that really helps everyone. But I think that the way that Dave does his spreads is awesome, and I think that he's had great success doing it that way, and it makes a lot of sense. But I also think that there's always different ways to perceive spreads and different ways to look at it, and I think that there's benefits as well of using wider spreads at times as well. But I think that there's no wrong or right way. It's just how much risk you want to take and what you your strategy and your plan. So yeah, I mean, let's look at it. Let's do an example on a Celgene spread now. So, and these are next week's. So this is actually a great example. And actually, I want to look at Celgene real quick. I just want to, because Celgene broke a wedge, right? It broke that wedge that I showed you guys last week. Now, it is very strong, but it did like flat. So it broke this wedge that it made, which I can't really depict on this chart. Let's see if there's any way. Is there any way I can get that chart? No, I can't. But I mean, this chart's the same thing. So basically, we had a big wedge, right? We broke out of the big wedge to the upside on Wednesday, right here, right? And we closed above the previous day's high. And then we flagged. So we even had like a short-term flag where we had this huge move up of like 250, and then we flagged down like $1.25, right? So we actually retraced this one day's movement like about 50%, which is a nice healthy flag retracement. And then Friday we just busted above, closed above the previous day's high, and we closed close to the high. So that's really bullish. Now the one thing I would caution is it was expiration Friday, and I'm always, guys, on Fridays I'm always less apt to want to open any trades, just because, especially expiration Fridays, because expiration Fridays, like, there's so many things at play, because there's so many options there's so many derivatives that need to expire, and so to think that the market's not manipulated, it would be kind of, I feel like, naive. So my opinion on expiration Fridays is the market is always manipulated, because there's the derivatives market, the options market drives the stock market on expiration Fridays. There's so many options that need to expire, and there's certain points where they want the market to be to get them all to expire the way they want. It's just, I feel like the market is always manipulated on Fridays, so that's basically why I don't on expiration Fridays, especially which is the third Friday of every month. Now I know every Friday is expiration Friday for options, but I'm saying like big expiration Friday, the third Friday of every month. I feel like the market is the most manipulated, and that's why I'm never trying to open a lot of trades on Fridays, or opening less trades than I normally would. So it's something to be aware of. But we did close above the previous day's high. So I mean, Celgene's chart still looks great to me, and I think if the market holds up and continues higher, Celgene can blast off up towards 125. So this is still a decent entry point on Celgene. What we would have to do is we'd have to use Friday's low as a stop if you're going to get into this trade. And like I said, the previous day's highs and low when we're swing trading options, the most important thing to see. So, it wouldn't be a bad risk point to use Friday's low as a stop, because the low was about, what, 119, 118? The low was like 119, so we're risking $2. It can easily run $4, so it's very quickly that's a 2-to-1 reward to risk, right? The reward would be about $5 and the risk is about $2. So yeah, I mean, so let's look at the chart and then we'll look at so what do we think Celgene is going to do? I think Celgene can rally next week. So then let's go look at the chain and try and structure a trade for next week. Okay, so here's an example, right? So we'll give a couple of different examples. Now, we could do the 121, 122 spread. And this way, we only need Celgene to be at 122 by expiration next week. And if we're doing a spread that narrow, it makes the most sense probably just to hold until Friday and just let it expire above 122. I think by next Friday, Celgene can definitely be above 122. Now, no matter what, if we're planning to hold it until expiration on Friday and it's going to be above 122, the first thing we need to know is what are we risking? How much are we willing to lose? So we said we're risking about $2. So if we buy the spread and it goes down $2, the spread would be about, let's just assume we pay 135 on the ask side, right? And then we're able to sell this for 85. So 135 by 85, that's 50 cents. So we'd be paying 50 cents for this spread. Now, if Celgene goes down $2, what's our net delta? Our net delta is 13, right? Because we're shorting this 40 delta, we're longing this 53 delta. Our net delta is 13. So if Celgene goes down $2, we're going to lose 50% on this spread, about. And that's our risk, okay? So we're risking 50. If we want to do this 121, 122 spread, I'd be risking 50% on it. I'd be stopping out at about 25 cents, and we're paying about 50 cents on the spread. And so we're risking 50% to make 100%, right? Because can make it about another 50 cents if it expires above 122. So that's an example of a tighter spread, right? Now let's look at a wider spread. Let's say we want to get the 121, 123. Now, if we get the 121, 123, and actually, I'll even show you, we'll do this. We'll first look at the 124. So let's say we want to do the 121, 124 call spread. Now, what is the goal of this spread? This is what I'm talking about, where when I do spreads, I look more at I don't care about if it's at that strike at expiration. I just want to use it to lower the cost of my trade and assume that, I'm shorting this 124 strike and that the stock's going to get nowhere near it, which is fine because we're shorting it, right? So this is an example of kind of how I look at spreads. I wouldn't be looking, if I'm going to open a spread in Celgene that's going to expire on Friday, I'm not going to be looking to hold till expiration usually. I'm going to be looking to just profit. And so what I would do is, here's an example of why I would do a wider spread, right? If I did the 121 by 124 spread, planning to not hold it until expiration, and planning to just catch a move and profit and move on, now my delta is going to be 19 minus 53, which is 34, right? So my delta is 34, and it can move. If it moves a couple bucks, I'm going to make more, right? Because my upside's less capped. Let's say if it moves $1.50, I can make more. And let's do the cost. So the cost of this trade is 135 by 30. So 135 by 30 is going to be $1.05. So the cost of this trade would be $1.05, and I'm risking $2. And if I'm risking $2 with a net delta of 34 or 35, I'm going to lose 70 cents. So we're risking more, right? Because we're paying $1.05, and we can lose 70 cents if we're wrong. But we can also make more as well, because if it moves up $2, let's say it moves up $2, and then if it moves up $2, we're gonna make 70 cents. So we'll be at 175, and then yeah, I mean, and we can even make a little bit more, depending. But that's kind of the difference in wider and tighter strikes. Whereas like a 124 strike, I'm not waiting until expiration, and I don't want this to be at 124. Basically, what I want is I just want these calls to not be worth anything, and just that lowers the cost of my overall trade. That lowers the cost of my overall calls that I bought here at 121, and yeah, I mean, it's just more upside and more risk as well, and shorter holding period. So yeah, I mean, that's kind of the different aspects of wider and tighter spreads. Let's see if anyone has any questions. So Panda, I like my first strike to be 50 cents. Or I mean deltas. So I always want to keep my delta above 50. So usually my first strike's going to be, right in the money a little bit, right? Sometimes I think Dave does ones where they're a little bit out of the money. Now further in the money, it's just less risk, less reward. Whereas I like to keep the delta that I'm buying in the 50 range, so a little bit in the money. You're just risking less to make less the further in the money you go when you do spreads. Okay, does anyone have any questions on that? Okay, I don't see any questions, so let's see. Now, the one other thing I want to share with you guys is something that I think everybody should be watching intraday. If you're watching the market intraday, and by intraday I mean like on a shorter time frame than daily, I think everybody needs to be watching the E-mini, which is SP 500 futures. This is kind of what drives the market. This is going to give everyone an idea of what the market's doing every day. It's like the barometer of the market. So I think that this should always be on everybody's radar. I like to watch either the 15-minute or 30-minute candles on the E-mini intraday. So yeah, I mean, that's another thing that I think everyone should be watching and kind of aware of for intraday analysis. Let's see. We have like 20 more minutes, so yeah, we have like 10 to 15 more minutes. So does anyone have any other questions? Anything that we want to go over? Or I can just share with you guys the other stuff that I have. Well, we don't really have a lot of time to talk about day trading, Raghu, and we don't really day trade on this interlay exchange. But the first step I'd say is definitely Well, the first step for beginners is to get good at swing trading. And then once you're comfortable and you're really good at swing trading, which swing trading is holding anywhere from a couple days to a couple weeks, which is what we focus on at Sin Relay Exchange. Once you're really good at swing trading, then you can kind of venture into day trading. And I think the first step, like I said, of day trading, if you want to prepare yourself to day trade, just start now watching the E-mini every day. Just watch it every day, get comfortable with how it moves, get comfortable with the times of the day when it's just all noise, get comfortable with the times of the day of when it actually trends. Just get comfortable watching the E-mini because that's what drives everything in the market. So when you actually do start day trading, you'll have a good kind of something that you're already comfortable with and you're already looking at. Because like if the E-mini's rallying, you never want to be on the stocks that we trade. At least if the E-mini's rallying, you don't really want to be looking for bearish trades intraday, and then vice versa as well. So we got a couple questions here. This is good. All right. Is there a technique to sell a spread? I try to sell before expiration and put it in a limit price like 240 or 250, but it doesn't get filled. So there's no real technique. You just have to put in, Rick, you just have to put in the limit, but you have to make sure that the limit is kind of at the midpoint or close to the midpoint, or else it won't get filled. And if you're saying you want the 250, if you're doing a 250 spread, you'll never get the 250 before expiration. So if your spread's 250, don't ever expect to get that full 250 unless you're waiting until everything expires. If you're doing a 250 spread, expect more to get like between 2 and 220 if everything's going well. And that's what I'm saying. Like if I do a 250 spread, right? And I can take $2 out of there a couple days in advance, I'm never going to wait for that extra 50 cents. I'm just not going to do it. And that's just my preference. So, and you really can't expect to get the full spread until expiration. So yeah, I mean, you guys asked about Tesla. My opinion on Tesla is that it's a piece of caca. They make no money. They have no earnings. They're burning a ton of cash. My opinion on Tesla is always shorted in earnings. So I mean that's my opinion. Now I definitely could be wrong, and I'm not advocating to gamble, and I'm not doing anything on it. But that's my opinion on Tesla, is that it's especially with the way it's rallied this past month. I think it's definitely ripe for a huge like 30 or 40 point move down, or 30, 40 point move up, and it could go either way. But I just feel like it's rallied so hard into this earnings report that's this week that it's just setting itself up to just get obliterated. And the way that they report earnings is they do like non-GAAP, and it's just crazy if you actually look at the fundamentals how terrible of a company it is. But everyone likes it because they're innovative. So, I mean, that's my opinion on Tesla, is that I always think it's gonna crater because the fundamentals aren't there. It's just not. They don't make any money on a GAAP basis. Their non-GAAP stuff is like alchemy. So, I mean, that's my opinion. Yeah, it's if I was gonna say what way is it gonna go, I would say it's gonna go down 40 points after they report. But I'm not doing anything with it. And if you do something with it, I hope you don't decide to risk too much. Remember, proper money management is always max 3% risk of our account. So yeah. Okay. Any thoughts on Amazon, and do I like calendar spreads? So Paula, calendar spreads aren't bad at all. I usually just go the same date on both. But the benefit of calendar spreads is it just gives you the optionality, like if you want to go out, because you can buy strikes at different dates, but you have to. It's just how you structure your trade. I usually won't do calendar spreads. I'll usually just, if I'm going to go out, I'll just go out in both directions. But I don't see any problem with calendar spreads. I've never really used a calendar spread. I know that it's 2 different expiration dates. But yeah, I mean, if I'm going to go out longer, I'll just do a spread on both sides, and then, that will benefit. If I'm going to go out long term, I always do a spread, though. I'll never just buy a call or a put going out long term, just because there's so much time premium, and there's just too much in that option where I want to be able to capitalize. If it doesn't go in my direction, I want to be able to capitalize on the short end of that spread as well. So any thoughts on Amazon for next week? Yeah, we can look at Amazon. So yeah, I mean, Amazon looks very similar to the S&P 500, and it is one of the biggest percentage holders of the S&P 500. So it's one of the top 10 companies in the S&P 500 of the largest size. So it makes sense that it looks pretty much almost just like it. But I mean, my thoughts are kind of the same for Celgene and same for the S&P 500. I think that everything is way overextended, and I think it's possible next week that we can get a little pullback, especially now that Expiration Friday is done and over with. I think that there's definitely risk next week, and I think that there's a good probability that we're going to get a pullback next week at some point. Now, I'm not, obviously, that's just the way that it looks. We could stay overextended for another couple weeks to a month. We could just keep rallying. But when we get this far up, especially on the S&P, it's just there's so much risk to the downside. Where that's why I don't like to. Where this overextended, I just don't like to open a lot of new bullish trades because there's so much risk to the downside, right? I mean, in every trend, the market retraces. The market never goes straight up, and the market never goes straight down. It's stair steps. So, yeah, I mean, it's pretty easy to see how much risk there is to the downside. But that doesn't mean that we're going to stop rallying. We could keep going. But, what I think is this is what I would do, guys, and this is what I always do. I watch the previous day's lows and highs. So on Tuesday, when the market reopens, I'd be watching 23.39. If we close below 23.39, that's kind of where I'd be ready to try and ride a little retracement down. So that would be kind of a good place to have some stops, is to close below Friday's low. And if we don't, if we close above Friday's high, then we're going to just keep moving. We have a little ceiling here at 23.51. So if we close above 23.51 on Tuesday, we can continue moving again without any real retracement. But I mean, when I'm looking at any stock like Amazon or Tesla or like what I think or Celgene, it doesn't really like the actual stock isn't as important as what I think the S&P 500 is going to do. So that's why I'll drive that home too. Is always we should be looking at the market first, not stocks. And then base what we think the market's going to do, like the S&P, what we think that's going to do, then that's where we go look for stocks that kind of line up with that theory. So like when you ask when someone asks, what do we think Amazon's going to do? What do we think Celgene's going to do? What do we think Tesla's going to do? The first thing we should look at is what we think the market's going to do, like the S&P 500. And small caps. Now, the thing with small caps is they've been pretty strong the last week. And the other thing with small caps is if Trump actually comes out with his tax cuts, small caps are definitely going to benefit the most from that. So watch for that. If something comes out about the tax cuts, I expect small caps to really explode. And IWM is my favorite index ETF to trade. So, but I always look at small caps because when we're aggressively rallying, small caps are usually leading the way. That's where the big gains are had by all the professional money, because a small cap company can, a $1 billion company or $800 million company, those companies can double in size very easily. Whereas the bigger cap S&P 500s, those don't, the gains in those won't be as big. They can't really, it's not as easy for them to double. Apple's not going to double. Amazon's probably not going to double anytime soon. Google not going to double. Those companies are already like, their sizes are like $500 billion, right? Like, Google's, Apple, Amazon, they're all like $400 or $500 billion companies. So yeah, that's why the money goes to aggressively to the small caps when the market really starts to heat up, because it's an easier place to get big gains on, because they're smaller companies, right? So upside. Small caps explode to the upside is what I mean if the tax cuts come out. Yeah, you could do that as well. You could turn a call into a spread as the market moves up, but you also have more risk, right? If you just open a call and you're assuming that you're just gonna open a spread when it moves with you, yeah, that sounds like a great plan. But then what about when it moves against you? It's just more risk too. So I'd rather open the spread at once. But yeah, you could do that for sure. There's so many different ways to play the market. I think what the most important for everyone at the San Rafael Exchange is to understand what Dave does first, because he's very successful at what he does. To understand what he does first, the what, and then once you understand the what, then you can start trying to understand the why. And then once you understand the why, then maybe you'll have some things that you'd like to do differently. So there's no only one way to do something, especially with options. I'm just trying to help you guys. We just try and help you guys as beginners, especially. You want to be making sure that you're protecting your capital. That's like our number one goal for everyone is to protect. Like, our number one goal is not to profit. Our number one goal is to protect what we have. And I just try and drive that home, like risk management, money management. It's more important to protect what we have than it is to profit. Okay? Because you want to stay and keep yourself in the game, and you don't want to blow yourself up and take unnecessary risk. You will succeed if you keep yourself in the game, and if your number one goal is to protect what you have, you will eventually succeed. If all you care about is making a lot of money and taking a lot of risk, then you will probably inevitably either make a lot of money or fail until you change, kind of what you're doing with your risk and everything. So that's why we try and help everyone understand that the most important thing is risk management and not taking a lot of risk. And I think the way that Dave structures his trades is great for that. So, Raghu, you know what? We can talk about that some other time. That's like day trading the IWM. That would take like probably at least an hour for me to explain all that. And we're wrapping up here kind of soon. But if that's something that a lot of people want to see, we can put something together for that. But I think that we're focusing more on swing trading. But yeah, if everyone wants to see that, we can do that at some point. But that's going to take a while to. I think the most important thing is for everyone to have everything down for swing trading first before we even consider day trading. As a beginner, you want to be able to be successful swing trading, where you're holding for longer terms of period, you're taking less risk, you're going out further in expiration. You want to like really get all that down first before you move to day trading. Any small caps on my radar? I mean, I like the airlines. I think Delta Airlines is a good small cap. DAL. Other than that, no, not really. I just like the IWM. But I mean, yeah, you could. I mean, a good thing to do, right, is you could easily, if you want more upside. But the thing about small caps is most small caps aren't that great to trade options on. There are some, but not many. So that's the other thing about that. But I mean, when you're investing for the long term, one of the best things you could possibly do is look at all the holdings of the IWM, all those small caps, and try and find some of the best. But I mean, that's what I would do if I wanted to actually trade small cap companies. I would look at the IWM holdings, and then look at companies that have the most liquid options and try and trade them. I think Grubhub is a decent one. Delta Airlines, I think, might still be in there. I haven't looked at small cap holdings in a while. I usually just trade the IWM straight because it's the most volatile ETFs and it moves a lot. It's a great thing to day trade options on as well. But we're not really focusing on day trading right now. But it's just even swing trading. It's a great thing to swing trade as well, which is but it's still better to. The stocks that we focus on will still give more upside. As the stocks, individual stocks always are going to move more than the indexes, usually, especially the tech ones. But also QQQ is another decent. The QQQ and the IWM, in my opinion, are the two best index ETFs to trade. And QQQ is the NASDAQ 100, so it's the top 100 tech companies. So what we see is, tech has been the strongest. And actually, what happened with the QQQ on Friday was it closed above Thursday's high, which is a very strong signal. So tech has definitely been leading this rally, for sure. Tech. But what we have been seeing in financials, I think, have been decent. XLF is a financial ETF. So financials have been decently strong, but what I have been seeing here the past couple of days is the biotechs have started picking up, which is why I like Celgene. So IBB is a biotech ETF. Celgene is one of the top holders in that. Celgene is like my favorite biotech to trade. It moves a lot. It's a great company to trade, and it's also it's one of the most profitable companies in the whole stock market because the healthcare industry is just ridiculous the way that it's ran. But yeah, I mean, it is one of the most profitable because of the way it's ran, because they can just sell drugs for whatever price they want. But yeah, so I mean, that's been picking up. So biotech's been picking up lately, which is a decent sign for the market. And the small caps, biotech, and then tech can stay strong. The market should take off again. Yeah, we might be able to talk about that next week. If that's all right, if that's what everyone wants, and that's what Dave, that's the direction that Dave wants to go, then yeah, we can talk about that. We have a little bit of time left. Let's see, is there anything else? What stinks is I didn't get to share these charts with you guys. Maybe next time. I have, from my Bloomberg, I pulled the last all 20% correction since 1987. So yeah, I don't really have a lot of time to share that, but let's do one thing and look at the last big collapse we had in 2008. Let's just look at this chart. So, like I was saying, you see the first thing that happened when the market started rolling over was the 50-day, right? So here's the key. The 50-day is the blue line, and the 200-day is the pink line. The first thing that happened was price went below the 200-day. And then we got the bearish cross. The 50-day cross below the 200-day. That's like the first real signal that things are starting to change. And I think that's a great indicator for anyone to use, especially newer people. Is that's the indicator. When the 50 crosses below the 200-day, that's an indicator that things possibly are going to start to change. And then price rallied back up to the 200-day, and then that's when we collapsed. This was the last collapse we had in 2008. It was a 58% pullback from peak to trough, and this was in 2008, 2009. But yeah, I mean, that's just an example. We always need to be aware of the 15 200-day. And then I have the 17 EMA on here, which is like a good short-term indicator. It's exponential moving average instead of simple. It just gives more weight to the days that are closer. So yeah, and next time maybe we can look more at those. So does anyone have any more questions? I'm gonna make sure that I get my internet. I don't know what's going on with it, but I make sure that next week it doesn't do this. So yeah, and I hope the video uploads properly. As long as it uploads and it's there for everyone. If it uploads all choppy, that's not good. I hope it doesn't do that, but does anyone have any other questions? If not, that is going to be it for today. Look forward to working with you guys again on Tuesday and all week. And if you have any other questions, feel free to ask them in the chat when I'm there in the AM, or you can ask them to Dave at any time. And let's focus more moving forward on whenever we do these sessions on Sunday. Like I said, I want to make them as interactive as possible. So I want everyone to bring their questions. And I think the perfect session would just be us talking about all the questions that everybody has, and then all concerns they have, and how they want to get better, and all that stuff. Eventually, after we've driven all these training points home. But yeah, that's going to be it for today, guys. I hope you found this stream helpful, and I hope that, like I said, it uploads properly. We will see about that. Everybody enjoy the rest of their long weekend. Enjoy Monday. Enjoy today. And that's it. Have a good one.